This video illustrates how a company's new product innovation program creates a proprietary investment opportunity. Investments in new product innovation can provide the enterprise with financial returns vastly greater than any publicly available alternative. Furthermore, the firm has complete freedom to manage these business investments in ways that both improve their financial return and their performance when circumstances change. This is a generic representation of the innovation system that can be found in every company that achieves financial growth through the introduction of new products and services. Its operation and critical success factors are described in the video referenced here that was posted earlier. The earlier video addressed a comprehensive set of objectives that the innovation system must achieve. This one will focus on just two of those. First, it will address the creation and management of a proprietary investment opportunity. Brief case studies will be presented that highlight two familiar and very successful examples. Second, this video will describe how the innovation system affects shareholder value. The shareholder value of an enterprise depends strongly on its expected cash flow, so this is where we start. This is a graphic representation of a firm's cash flow statement. Its primary input is the net income produced by the innovation system. The enterprise may also receive cash flow from investments and financing. Net cash flow is what remains after any new investments have been made and all debts due to financing have been paid. The net cash flow for a hypothetical company is plotted here, beginning with the present time. This is the forecast period that the firm has chosen for itself. For now, we're going to assume this period is 5 years. Why we are doing this will become obvious. This is the cash flow during the cash flow period. A suitable present value calculation will determine its value at the point labeled present time. Rappaport cites a study that was performed on 30 companies that analyzed their historical cash flows and then showed how they influenced the market value of each firm's shares. The study determined that the present value of cash flow during a 5-year period from present time would only account for about 10 to 20% of each firm's share price. The remainder of the current share price was due to the present value of cash flow that occurred 5 years in the future and beyond. Rappaport defines residual value as the present value of cash flow that occurs beyond a firm's forecast period. If one of our objectives is to optimize growth in shareholder value, this aspect of a firm's performance is obviously very important. If the cash flow period that a firm chooses is different than 5 years, then clearly the results of this study do not apply as directly. Nonetheless, the conclusions will be the same. An overwhelming portion of the current value of a share of stock will be due to the present value of cash flow that occurs beyond the firm's forecast. By definition, though, residual value is determined by the firm's performance beyond the forecast period. This implies that we can't predict it, estimate it, or measure it at all. So how can we manage it? Two elements of the innovation system, the innovation engine and operations, work together to form a powerful core learning machine that establishes the proprietary investment opportunity. Here is an example of one such learning machine. At this level of detail, its attributes vary somewhat with the business model. This example, for instance, is typical of a company that develops, sells, and ships physically tangible goods such as laptop computers. The earlier video used this view to show how innovation efforts affect the critical success factors of the innovation system. Here we will use it to illustrate the impact that innovation activities have on shareholder value. The objectives of the core learning machine are to first, discover new and relevant ideas and opportunity. Next, these inputs are translated into winning product strategies and concepts. And finally, new product concepts are transformed into new value delivered to the customer. If we consider the nature of efforts underway in the various functions that are included, we can draw some conclusions on how innovation activities affect our cash flow analysis and perhaps how to manage the unpredictable. These activities, for instance, are all involved with either new products that are already in the development pipeline or existing products that are already in the market. They will thus have the dominant influence on cash flow during a firm's forecast period. On the other hand, these activities at the so-called fuzzy front end of the innovation process will be focused on discovering new ideas and opportunities and on creating and validating product strategies and concepts. The effectiveness of this work will determine the nature and value of new product programs that are undertaken in the distant future. These activities will have the dominant influence on the residual value of the firm. Planning and management of the activities that influence cash flow during the forecast period are relatively well known and straightforward. The secret to excellent residual value performance offered next is less well known. Strategic efforts accomplished during the forecast period prepare the enterprise to succeed at the end of the current forecast period. This work needs to include perception of long-range trends, discovery of lucrative new opportunities, strategy creation, product concept generation and validation, long-range technology development, development of key strategic partnerships, and growth in the firm's capacity to innovate. The alternative future that the firm will experience and the firm's current share price will depend on how well and how consistently it does this work. Our first case study is the performance of Hewlett-Packard before the changes that occurred in 1999. This graphic will describe how HP expanded its capacity for innovation by identifying and developing new proprietary investment opportunities. The origin of the graph is at the center of the baseline at 1940. Time is the radial distance outward from this point in all directions. The three regions shown are the major opportunity areas in which HP operated. HP was founded in 1939 with the introduction of its first product. From then until about 1960, HP had one business unit and one innovation system, represented here by our innovation system diagram used as an icon. The business model that evolved over that time focused on electronic laboratory test instruments. Between 1960 and 1980, HP's electronic instruments business expanded to address new opportunities. New business units and additional innovation systems were established. In addition, HP made inroads into the computer market with a line of handheld and desktop calculators. The company also entered the chemical analysis market during this period with gas and liquid chromatography products. From 1980 through 1998, HP expanded its computer product lines to include mini computers, workstations, and a full line of computer peripherals. Electronic instrument products range from general-purpose and microwave instruments to light-wave measurement products. In the 1990s, HP also entered the life sciences market and expanded its chemical analysis business. This relentless expansion of HP's innovation capacity drove a 40-year period of financial growth. Between 1958 and 1998, revenues doubled more than 10 times. The value of a share of HP's stock doubled on average every 5 years. This growth was incredibly consistent, even when the Dow Jones Industrial Average went flat for almost 20 years. During this time, HP created about 100,000 terrific new jobs. Our second case study is Apple's performance after Steve Jobs returned in 1997. To begin, here's a look at their overall share price history. Apple's history can be described in 3 phases. The first is the innovative startup led by Steve Jobs. The second phase was led by 3 different CEOs and might be described as a managed enterprise that became a leadership crisis. Share price during this time was essentially flat at around $1.50 a share. Phase 3 began when Steve Jobs returned to Apple in 1997. At the beginning of Phase 3, the share price was essentially flat for about 5 years. After that, it enjoyed a 13-year period of consistent and explosive growth, averaging almost 47% per year. A good name for this phase would be seasoned innovation leadership. This graph describes how Apple's transformation unfolded during Phase 3. Here is the revenue history, and here is how net income performed. Negative numbers do not plot on a logarithmic scale, so annual losses are entered here as red text. Company leadership is illustrated across the top of the graph. Steve Jobs returned to Apple in the summer of 1997, just before the end of that fiscal year. The company would declare a loss of over $1 billion for that year and was on the verge of bankruptcy. On returning to Apple, Mr. Jobs first restructured the current R&D portfolio and then initiated a major strategy creation effort. This resulted in what Apple called its digital hub strategy. In the years that followed, this strategy sparked a bonanza of highly valued and extremely profitable hardware and software products, along with associated services. As these products emerged from the development pipeline, revenues and profits began to respond. Once it began to rise, annual revenue growth rate quickly stabilized at over 44%. Growth in net income increased sharply and then stabilized at a growth rate of over 65% per year. The strong synergy between Apple's product offerings presented customers with value propositions they simply couldn't resist. As a result, profit margins increased dramatically. Net income, shown on the right vertical axis, was over 20% of revenues. The success of the digital hub strategy and the financial results that it generated, along with the expectation that this success would continue into the future, were driving forces that caused the rapid and sustained growth in the market price of Apple stock. The return on innovation investments depends on how they impact operating income. This equation provides a straightforward method for calculating the financial return on innovation. Apple's performance from 1997 through 2013 is shown here. Innovation investments were determined by multiplying Apple's R&D expenditures by 1.2 to allow for other efforts besides R&D that are essential to new product innovation. The average return rate is almost 217% per year. This means that for every dollar invested in new product innovation during a given year, on average, an extra $2.17 showed up in the operating income for the following year. Over time, this transformed Apple from a company on the verge of bankruptcy into the world's most valuable corporation. In summary, there are 3 key elements to success in creating a proprietary investment opportunity. The first is that insightful leadership from business unit executive leaders is essential in achieving high returns from innovation investments. Second, every new innovation system needs to be nurtured and protected until it gets going. Executive leaders must provide the needed protection. And finally, the strategic efforts at the front end of the core learning machine are crucial to high returns on innovation. They establish future revenue and profit potential, greatly influence the market value of the firm's stock, and discover and shape new proprietary investment opportunities. I hope you have found this video worthwhile. In closing, here are some additional resources you might find useful. If you have any questions, please contact me at the email address shown here. Thank you for your time and attention.